So now the audio should be clear, right? Yeah. Perfect. Yeah, that's what I was wondering. I don't know, just with those wireless phones, headphones, you'll always have some static. I don't know what the issue is. Perfect. All right. So I guess the Excel was shared by the support team. So Yogira, you should be able to find it on LMS. Yeah. So they're usually shared right after the class. All right. All right. You should be able to see it on the LMS.
Nitin, just to confirm, like for MMT1, there were no files actually.
No, for the previous, for Excel. They're asking for the Excel file, in-class file yesterday.
All right. So students, I just want to update you that the file has been already updated in SFM01. The same file, you just need to re-download it once again because it's a zip file. So we have included that file, that in-class file. It's naming like in-class XLP.
All right, perfect. So Rahul comes to the rescue. Thanks, Rahul. I appreciate it.
Okay,
All right.
thanks.
Okay, perfect. Well, now you know. So yeah, now you know. All right. And obviously, if you are having problems, just shoot an email and it should be resolved. Right. All right. So starting with today's lecture. So what we have for today is, now this lecture has been divided into two parts, right? So what I'll do today is I'll talk about order books. What are order books? Type of orders, right? When you have to give some instructions of a buy or a sell to the exchange, right? You have to send orders, right? So what are the different order types that you can send? Some small strategies that people use in order management and whatnot. And then obviously I'll talk about order book, right? What is a limit order book and what is the matching engine for different exchanges. So I'll talk about that, and finally I'll talk about some pegging orders and discretionary orders. So this is one part of the lecture that I will be covering today. In the second part, I will talk about VWAP strategies and different trading strategies based on what we learned today, right? Based on the sort of order types that we learned today. All right. So I think the presentation has around 80 slides. So just for you guys to know, I'll cover around 35 to 40 slides today. So at the end of the lecture, you don't think that I missed some things. All right. Okay, and what I'll try to do is, depending upon the question, I think I'll just leave around 15 to 20 minutes towards the end of the class free, so that you guys can ask questions about the lecture today, or if in case you had any questions yesterday which were unresolved, so you can ask those questions towards the end of the class, right? The PPT should. So if it is not shared, that's fine. Just I would rather have you concentrate on my screen, and then after the lecture you'll have the PPTs and the in-class files if any are used. All right. Perfect. All right. So I just want to start with algorithmic trading, right? This is the quant course, right? So how did quantitative finance come into picture, right? So before sort of the computer revolution, right? People used to call their brokers if they had to buy a stock. They had to call their brokers and they had to sort of tell them that I want this quantity at this price, right? And it was a tedious process. But with computers, it really changed the finance industry, as it did with a lot of industries, right? Engineering, sports, and whatnot. But it definitely changed the finance industry, right? So Now, what exactly did it do? So earlier you had to, there was a lot of human intervention, right? What price did you want to buy? What price? What quantity? Which share? So with computers, you could set up algorithms, right? You could set up instructions, and you could tell the computer that, you know what, this is the stock, these are the conditions at which I would want to buy a particular stock at this particular price, right? And the computer would then send an electronic instruction directly to the broker end or to the exchange, and your trade will get executed, right? So an algorithm is a specific set of clearly defined instructions: what to buy, when to buy, and how much to buy, right? And with algorithmic trading, obviously automated trading came into picture, right? You didn't have any human intervention, right? You could just write a piece of code on computer, which would then get evaluated every, depending upon what your instructions are, every second, every 5 minutes, and it will see whether you want to send a trade or not, right? So a lot of, it basically automated trading decreased human intervention. So just to give you an example, right? I mean, uh, I and my friends and my colleagues in high frequency trading, right? So we would come at 9 o'clock, start of the day, and we would just see that, everything has started. And believe me, I don't even press a button, right? Everything is automated. It automatically, my program automatically starts. It connects with the exchange. We see that everything is working, and then we go out, have a cup of coffee, and then, we just come back in an hour and see, everything is fine. So this is the level of automation that I'm talking about. You just don't even have to look at the screen, right? You know that the program that you've written will automatically take care of the trade, it will book profits, it will take losses and whatever, right? So this is what automated trading is all about, right? And it was obviously possible with the computer revolution, right? And this is not only with high frequency firms, right? I mean, high mutual funds, pension funds, institutional traders, a lot of intraday traders who are who trade at a 5 minute or a 10 minute frequency can do this, right? And why do we want automated trading, right? I think my biggest reason, or for me, the biggest advantage is no emotions, right? I have seen a lot of people panicking at a trading desk and punching in wrong trades just because, they couldn't handle the market crashes or the market rises, right? So there are absolutely no emotions involved in a automated trading platform, right? You are very disciplined in that sense. And in fact, I always say in a trading system, right, human intervention is the weakest link. So as quant traders, we should try to automate everything, right? And as we go on the course, as we create signals for our strategies, we will see that we can eventually quantify each and everything, right? And this is actually, for that matter, this is one of the values of my company, right? Everything is quantifiable, and we want to reduce human intervention as much as possible, right? Now, obviously, this is one, and for me, this is one of the biggest. But then again, one important thing is that you can easily scale up, right? So if I'm looking at 200 stocks, right, my computer allows me to trade in 200 stocks, and that's just how it is, right? So I mean, I don't need, for a human can possibly trade not more than, what I'll say, 15 or 20 stocks in a day, right? But with a computer, if everything is automated, you can really scale it up, right? And different markets, not only one geography, right? I can trade US, I can trade Singapore, Hong Kong, India, wherever, right? So it's highly scalable. And that is what, obviously, if you have a strategy that is profitable, it will, automated strategies can be scaled very easily, right? You don't need to hire anybody. You just need to run it in a different geography, right? So it's always important that way. And then obviously, people say that, and it's very true that, computers can react way faster than human beings, right? If the market is crashing, the reaction time of a human, of a trader, right, would be what? If he's very good, maybe it's 5 seconds, 10 seconds, right? Maybe 15 seconds, right? I mean, and that too, he can see it for, I mean, all the calculations, if you have to do calculations and whatnot, it might take him a minute or 2 minutes, right? If he's really good at maths. But computers can actually do those calculations in microseconds, milliseconds, right? So they can identify and they can react to opportunities very fast if you have an automated system, right? And that is, obviously, if you are the first one to react, then obviously it will increase your profits, right? So in fact, people these days are writing codes to save 2 microseconds, 3 microseconds, right? So that they are faster than the rest of the world, right? So in this way, quant, or for that matter, automated trading is really important, right? Trying to quantify everything, right? So as I said, if you have an automated system, you can identify and react to opportunities faster, right? And obviously it's very reliable, right? If a machine is doing your calculations, it won't go wrong, right? A human brain can make errors, right? There can be fat finger errors, typos, or whatnot. You can punch the orders wrong. In fact, there was a case, I think some time back, where a trader, instead of 1,000, I think he pressed, like, instead of 3 zeros, he by mistake pressed 6 zeros, for the quantity, and the company just went bust because of a simple typing error. So in that sense, computers are very reliable, right? Guys, you can hear me, right? All right, perfect. So one of our friends wasn't able to hear. All right, perfect. And as I said, I mean, in high frequency, or even in uh, in trading, where you need to calculate things in a minute or 2 minutes, or high frequency, you do it in microseconds or milliseconds. Saving that time to react can actually make a lot of difference, right? I mean, I know so many strategies that work because they can be evaluated in, say, 20 or 25 microseconds. And if the same time for those strategies was, say, 100 microseconds, they just won't work, right? So in high frequency trading, every microsecond counts, right? And in fact, people say that, what, oh, really, is 1 second not good for you? For us high frequency traders, 1 second is like a year, right? More than that, actually, right? So it's very, I mean, it's very important for us to quantify everything and generate signals through quantification, right? And as I said, you can track more markets simultaneously. It's very easy to scale it up. Reduction in emotion and increased discipline. I think this is one of, for any sort of strategy. In fact, even if time is not important for you, right? Even if you can do your calculations in 5 minutes and whatnot, I would still say automate it, right? Because it just decreases emotion, right? And believe me, if you are trading with emotions, you are almost guaranteed a loss, right? So it just increases discipline, right? Any questions? What is HFT? HFT is high frequency trading. High frequency trading. So I told you, right? So there are three main sort of strategies in terms of the time horizon, right? And when I say time horizon, so I mean the time in between which you hold your positions and you square off your positions, right? So fundamental traders, right? I hope you guys remember it from yesterday. They would hold their positions for 6 months, 1 year, 2 years, right? So these are all fundamental traders, and this is low frequency trading, right? They would take 1 or 2 trades in a week or in a month, right? Or something like that. Short term or medium term trading would be, if your holding position is 1 day, 1 week, or 1 month, right? So people who work on technical indicators and who are intraday traders, you buy in the morning, sell in the evening, right? So those are short term traders, right? And then high frequency is when you buy and sell every 1 second, 2 seconds, 1 minute, right? So where you generate a lot of orders within a second, right? So that is high frequency. Your frequency of trading is huge, right? So that is high frequency. Why do people use it? It's just another kind of I mean, people have different types of strategy, but HFTs are known to generate higher returns, right? So a lot of people are moving into high frequency trading and whatnot. All right. How algo and HFT are different? So HFT is a kind of algo trading, but in HFT your time frames are very small. So you will be generating orders in microseconds, milliseconds, right? Algorithmic trading can be, any system that is generating orders automatically, right? You've automated it. So your computer you fit in a code and your computer is generating orders. That is automated trading, right? Algorithmic trading. But high frequency is a subset of algorithmic trading, and just that in high frequency you are firing orders in microseconds, milliseconds, and whatnot, right? How fast can HFT be? Oh, it can be very fast. I mean, if you have to, you can probably send. I'll just give you a ballpark. You can send one order in I'll say 50 microseconds or 100 microseconds, or even less than that, right? So 1 second has 1,000 milliseconds, and 1 millisecond has 1,000 microseconds. So in a second, you should be able to send. If you really want to do it, you can send like 10,000 orders. All right. Okay. What is the level of profitability, and are you able to make with your logic of trades just to gauge the performance? So this is a bit confidential. I wouldn't want to share the profitability numbers, but I can say that any HFT firm can beat the index returns by 2 times or 3 times easily, right? Easily. So yeah. Yeah, I'll talk about co-location and whatnot, in a different lecture. So I don't want to lose track of what we want to discuss right now, right? So people, how much transaction cost is it with each order you place? It depends upon the exchange, right? It depends upon the exchange and depends upon the asset class, right? So it would be difficult for me to sort of generalize it. In Indian markets, if you're doing futures and options, then for $10 million, a trade of $10 million, you are charged $1,000, right? So for futures, I'm talking about futures, right? It would be different for options. I think it's 8 times more in options and whatnot, right? So there are a flurry of questions. Is Python suitable for HFT, or do we need C++? Most of the platforms, I don't know, people are really getting interested in HFT. First of all, I mean, before HFT, I was into algorithm. I mean, I was into, like, I used to trade every 30 minutes or so. It was sort of short-term frequency, but not HFT. And we used to make decent returns. So it's not because HFT would cost a lot of infrastructure, right? You need a lot of great servers and whatnot. So it's basically, it's your choice where you see yourself, right? Do you see yourself as, if you really want to take this as a career, or you want to do it as a hobby and whatnot, right? So HFT would really demand a lot of your time and experience, right? If that's how you want to do your, uh, if that's what you want to make as your career choice, right? Uh, if everyone goes algorithmic and there are no retail traders, will we get price movements? Of course we will, right? So not every algorithmic system will make money, right? So there would be some losers, some winners and whatnot. So, trading will always go on. And, algorithmic trading constitutes a substantial part of the whole trading these days, right? There's just one more question that I want to take. There was a person who asked, there are some manual traders who feel that their past experience helps them trade better, right? And it's not always easy to put in experience into an algorithm. So my friend, at the end of the day, any experience can be fit into the algorithm. And that is my belief. And that is my value, right? At the end of the day, a human being is also a machine, right? I mean, you can train your computer with machine learning and artificial intelligence. You can train your computer with experience. You just have to be good at it, right? So my personal, and people have different opinions, but this is totally my personal opinion, that everything is quantifiable and it can be coded, right? At least for trading purposes. All right. Let us not discuss the costs and whatnot, because I'll just take this offline. There are a lot of participants who might not be interested in that. So I'll just take that offline. You can just, and the costs and all are actually given on the website. So you can just see it on NSE's website. All right. So let me start with the order book. What is an order book and how markets work, right? So yesterday I showed you the OHLC, right? Open, high, low, close, right? And that's what trading of a stock in an exchange involves, right? Now, how are these open points, these lows, these close fixed, right? Between all these points, there is always a flow of bids and offers. What is a bid and what is an offer? And how does it really work? So markets are all about price, right? So let me just, so you guys can see the Excel, right? Yeah, guys, you can see the Excel. All right. So let us say, it's so trading starts at say 9:15 a.m. right? And at 10 a.m. you call your broker and you ask him what is the price of a stock, say any stock, right? So State Bank of India, right? Or better still, you ask, all right, state, or better still, an index would help. So what is the price of Nifty right now, right? And he tells you, what, it's 10,500. Now, what does it really mean, right? And he tells you that, what, it opened at 10,450 and currently it is trading at 10,500. Now, what does that mean? If I need to buy Nifty, can I buy it at 10,500? Will I buy it at 10,501, 502? What price would I buy? So what happens is, right at the start, right, there would be people, so let me tell you what is traded price and whatnot. There would be people who would be sending their bids, right? Now, what is a bid? A bid is simply a price at which a trader is willing to buy, right? So say at 9:30 a.m., there's a bid for, so this is the quantity and this is the price. So there's a bid for 100 shares of Nifty at a price of 10,450, right? So this would be a bid order, right? And any buying or selling happens through orders, and orders are nothing but their set of instructions, right? So a trader would send an instruction that I want to buy 100 shares at a price of 10,450, right? So this is a bid order. And then there are asks, right, with similar price and quantity. So say at 9:20, there was a person who wanted to sell 50 shares at 10,550. Is this clear? Is this clear? So this is how the instructions will stand on an exchange, and this would be visible to everybody, right? So this would be the bid that there's a trader who wants to buy 100 shares at 10,450. And I mean, the difference in time is just an example. I mean, there are orders every microsecond, millisecond, right? So I'm just trying to cool it off for you guys so that we can easily understand, right? So the time, I just took 10 minutes of time difference so that, I can just easily explain what is happening, right? Is this clear? And then say at 9:40, so now obviously because I want to buy it at 10,450 and somebody else wants to sell it at 10,550, there would be no trade, right? There would be absolutely no trade, right? I mean, I want to buy it at 10,450. Somebody wants, it's like saying that, you know what, I want to buy this apple at 10 rupees, at $10. There's somebody else who wants to sell it at $20. So obviously we don't trade, right? A trade will happen if the buy and the sell price match. So say at 9:40 a.m., there's another trader who wants to buy 10 shares at 10,500, right? And then at 9:50, there's another guy who wants to sell it at 10,510, right? And he wants to sell 100 shares, right? So this is how my order book will, so this assimilation of bids and asks is basically my order book, right? Right. And then at 10 a.m., right? So there was a person who wanted to sell 5 shares at 10,500, right? So he sent an instruction to sell at 10,500. And immediately the exchange will match this bid with this sell, and you will have a trade at 10,500 for 5 shares. Is this clear? Guys, is this clear? Arun, let me just discuss these sort of trading strategies later on, right? Let me get all the concepts clear, right? So I will take questions related to strategies afterwards, right? Yes, trade, and very important, the trade would happen even if the quantities don't match, right? So here it was 10. He wanted to sell 5 shares. So trade at 10,500 for 5 shares will happen, and the order book now will look like this. So now the order book would be, this would become 5 and this would get removed. So because a trade has happened, so 5 quantities from this 10 shares get removed. Is this clear? This is the order book that any trader would see. And this order book is visible to everybody. This is public information. And let me show it to you. So I go to NSE India, right? I type Nifty in derivatives. So this is, can you see, this is the order book, right? So there's a person who wanted to buy Nifty at 10,481, 675 shares. And there was a person who wanted to sell 600 shares at 10,485.9. Yeah. This is an order book for that particular exchange. Every exchange will have their own order books depending upon the orders that they get, right? Is the access to the order book free? Yes, it would be free. But if I'm looking at this website, it would be delayed. It might be delayed by 5 minutes, 2 minutes, I don't know, but it will be delayed, right? But obviously you can make your own order book through your own codes, because NSE will tell you which order came to the, or any exchange for that matter, any exchange would give out information that, you know what, this is the order that was sent to the exchange. This was the order that got traded. This was the order that got modified and whatnot. Some exchanges actually charge you to disseminate that information. So, but National Stock Exchanges gives you that information mostly free of cost. All right. Yes, the price is, so Akshay, was it clear that even the quantity wasn't the same, still the trade would happen, right? And there was a question, so price is moving up or down by traders reaching the bid or the ask and making an agreement in the price. That is exactly what happens. So the price of the asset would move depending upon the bid offers and the ask offers that are sent to the exchange, right? Can we hide an order? I will talk about the type of order, and I will talk about in that what all different can you hide, what can you hide, what can't you hide. All right. There are a lot of strategies that simply work on order book imbalance and whatnot, right? So yeah, there can be strategies, and we will talk about those strategies. Don't worry about it, right? All right. Is there any question? I will talk about how trades happen and whatnot, but is the order book clear? And I will talk about trades. I will talk about how will a trade happen, how are the orders matched, what price, if the bid is higher than the ask, then at which price is it executed. I'll cover all that, but firstly, I just wanted to make sure that the concept of order book is clear, because order book is important, right? To understand what is the situation of a stock currently, an order book is very important, right? You should know how to interpret an order book, right? Okay. I never said that quantity doesn't matter, right? Quantity obviously matters. So I said trade at 10,500 would happen for 5 shares, right? So this is the quantity. What is a tick? Tick by tick. So there's something called tick by tick order, tick by tick data. An order is just a tick, right? So any instruction given to an exchange is called a tick, right? So that tick by tick is order by order data, right? What order went through the exchange? What was it? Was it a bid? What is it an ask and whatnot, right? How can I get access to this order book? So I just wrote, so say equity, so say bank nifty, right? So I just press bank nifty, I press enter, and the page that opens will have the order book right there, right? So this is the intraday, this is the order book, historical data, fundamentals and whatnot. So under fundamentals, you'll have the current order book, right? But this would be delayed. This order book is maintained by the exchange, right? Because they are the ones who are matching the orders, right? So they have their own matching system and whatnot. Not delayed version, my friend, then you'll have to get data from NSE and you'll have to make your own order books, right? And if you're interested, we can talk about that. I mean, every high frequency system has that, right? For the, yeah, more or less. All right. So you'll have to sort of program it yourself. All right. Did I miss any question? Yeah. Manish, we can take that offline. Yeah. Perfect. All right. So let me just move on. So markets are all about price, right? They are all about price, right? And frankly, saying that a trade happens between bid and ask is very simplistic, right? There is, I mean, saying that what is the price of the asset right now is it's somewhat, and we will cover that. I will tell you how, I mean, what is my view of the correct price and whatnot. But just saying that the price of a stock is 10,500 does not tell me anything about the order book. That's just the last traded price. If I know the bid and the ask, that is what tells me that where, at what price can I buy it, at what price can I sell it, right? So obviously, for a trade to happen, the person willing to buy and the person willing to sell have to agree on a price, right? All right. I will talk about spreads in some time, Ravi. So let us not jump the gun, right? Let me just take the flow as it is, right? And I will talk about all these things easily, right? Okay. So I've already told you that orders are basically instructions, right? Given by traders, and they basically specify what to buy, when to buy, how much to buy, right? And whatnot. So these are the fundamental blocks of strategies. And so, whenever a bid offer or an ask offer is coming to the exchange, right, that is producing liquidity, right? Now what is liquidity? Liquidity simply is volume, right? If I want to buy a stock, right, how easily can I buy it? The more the more ask uh, orders on the exchange, right, the easier it would be for me to buy it, right? So if I just have to compare to stocks, so Nifty, you can say, has a lot of buy orders and sell orders, right? It has so there's somebody who wants to buy Nifty at 25, bank Nifty at 25,351. There's somebody who wants to sell it at this price. Now let me take a stock like GSFC, Gujarat State. For now, the order book of this is pretty much empty, right? There are no selling, there are no sellers. There's just one buyer at towards the end of the day. There's only one buyer who wants to buy at 93.25, but there are no sellers. Right, so this guy cannot buy the stock even though he wants to buy it at 93.25 because frankly there are no sellers. Right, so there's a liquidity problem because I cannot buy this stock because there are no sellers, frankly. Right, so any investor that is posting an order, right, an ask order or a bid order, right, they're basically providing liquidity to the exchange, right, because somebody wants to buy, somebody wants to sell, so they are making buying and selling easier, right? Is that clear? So there's a question, can I differentiate between a trader and a broker? Yes, let me do that. A trader is a person who wants to buy a particular asset or sell a particular asset, right? Broker is sort of an intermediary who connects the trader with an exchange. So exchange is the marketplace, right? Exchange is like Amazon, right? Who would, it's a marketplace, right? People, buyers and sellers would go there and they would buy or sell assets, right? But exchanges can be, so for example, Amazon can be, anybody can access Amazon, right? I just have to click amazon.com and I can access it, right? But exchanges don't allow direct contacts, right? There are only certain people through which you can you can connect to the exchange, and those people are called the brokers, right? So it's sort of an intermediary service, right? Is that clear? Yeah, perfect, perfect. So then any investor who wants to buy or sell is providing liquidity right now. So this trader wants to buy at 10,500, this wants to sell at 10,500. Now there are some people called the market makers. These guys would provide both a bid and an ask. So this was a trader one, right? This was trader two, right? What market makers would do is they would say, you know what, I want to buy two shares at 10,501 and I want to sell, say, three shares at 10,508, right? And this is the same trader, trader uh, 5 and trader 5. The same trader sends these instructions to the exchange, right? These are called market makers. Now, what this market maker is doing, he's probably figured out that, you know what, maybe the asset price is, say, 5 or 10. This is the fair price, right? At this moment, at say 10:05, he, through his codes or whatever, he figures out that, you know what, the fair price of this asset is 10,505. So I will send a bid order at 10,501. I will send an ask at 10,508. If I buy, I bag in a profit of 4 based on the fair price. If I sell, I bag in a profit of $3. If somebody buys from me and sells from me and same quantity, I automatically get $7. And this difference between the bid and the ask is called the bid ask spread. Is this clear? Broker's order book will not differ. I mean, if a any so anybody who's listening to the exchange, right, who's getting who's interested in creating an order book would not be different for anybody, right? Every broker, if a broker is maintaining an order book, frankly, for each broker, the order book has to be the same, and it is available, and it has to be the same. It's impossible that broker one has a different order book and broker three has a different order book if they're connected to the same exchange. All right. Now this is the $1,000,000 question. How would people know the fair price? The market maker know the fair price through his algorithms. Through there's some strategy, and he calculates the fair price. And when we'll be talking about strategies and options and futures, we will see how people calculate a fair price, right? Or how we can calculate a fair price. But for right now, let us assume that these guys have done it some way. So this is what market makers will do. They will provide a bid and the ask, and they will try to capture this spread, right? Market maker is a normal trader. He's a normal trader, right? So he's a normal trader and he wants to earn. Mostly high frequency traders are market makers. A lot of them are market makers, right? So they quickly change their bid and they ask depending upon the fair price. I will explain the market making example again. So, a normal trader is, if I want to buy an asset, I will send an instruction to the exchange, right? That I want to buy this asset at this particular price, this particular quantity, right? And if I get traded, well and good, I'll get the asset. But if I want to sell it, I will sell it off. But what market makers do is, one particular time they would have both bids and the asks, right, in the market, right? And so they would determine what they call as a fair price, and they would send a bid order slightly less than the fair price, and they will send a ask order that's slightly higher than the fair price, right? Many HFT traders are market makers, not all, right? Not all. So I have some strategies that make markets. I have some strategies that frankly, that remove liquidity. So I'll tell you, now that you've asked this, I'll tell you what removing liquidity is. Now, so say this is the order book at 10:05. Now, if say Nitin comes along and at 10 a.m. he fires an order. He wants to buy 3 quantity at 10,508, right? So a trade will happen. Trade will happen at 10,508 for 3 quantities, and the order book will be like something like this. Bid. Now the bid would be still at 10,501, 2 quantities, but this ask would get removed, right? So this ask, which was at 10,508, will get removed, and right, so this gets removed, and the previous 10,510 ask for 100 quantity by trader 2 remains at the order book. So this order by Nitin, so this was the order number, whatever, 7, 1, 2, 3, 4, 5, maybe 10, right? Order number 10 removed liquidity, right? Because it widened the ask spread. Right? So there was some liquidity, it decreased the volume, right? Is this clear? Guys, please, pertain your questions to what is being discussed. Right? If you guys are asking me questions about options or futures, that does not make sense, right? I'll be more than happy to discuss those offline, right? But please pertain your questions to the class, right? That would be great. So market makers can send their orders at the same time or in an interval of some seconds, some minutes, but usually market makers would would want to buy and sell in the same time, right? All right. Anybody can place an order both on the buy side and the sell side, right? I mean, it's not that there's a special instruction given to market makers or there's special title for my market makers. I can do it. You can do it, right? But if you know the fair price, you can do it easily, right? So it's not a big deal. They just want to earn the bid or the ask spread, right? Do we get the historical data for bid and the ask? Yes. If you pay, you can get anything. All right. Did I miss any question? Did I miss any question? There was a flurry of questions. So I hope trade of trader one. Hey, dude. What did you not understand in the trade for trader one? Yes, any trade would reduce the liquidity. Rishabh, what did you not understand in the trade for trader one? So I guess this was the trade for trader one. What did you not understand in that? Quantity and price relation. So, so this trader one wanted to buy 10 quantities at 10,500, right? And there was a person who wanted to sell 5 shares at 10,501. So basically trade will happen at 10,500 for 5 shares, and trader one will have 5 shares in his account, and he would want another 5 shares. And I mean, 5 shares would be left. 5 shares would be left out of the 10 that he wanted to buy. Is this clear? If you place an order, a future order on buy, you can immediately place an order for sell also, right? Obviously, I mean, the prices have to be different, right? I mean, if you send an order for buy at $100, you won't want to send a sell order for $99, right? I mean, this does not make sense. But if you send an order for in futures for 100, you can easily send an order for 101, right? To sell it off. So you can do it. I don't know why you're saying you cannot do it, because I do it every day. So yeah, you can do it, right? All right. All right. So I will take the open and the close auction a little bit later, right? Let me just sort of take this order book and how trades happen right now, right? Are not the bid and the ask market makers inflating the price? Not really, right? If the fair price is 10,505, if I want to buy it at 10,500 and if I want to sell it at 10,508, how am I inflating it, right? I want to sell it at a slightly higher price. And for that matter, any trader, right? Even physical traders, any retailer, distributor would do the same thing, right? They would buy low and sell high, right? So they're all traders. They're just, I mean, they're not trading on the exchange, on the stock exchange, right? They're just trading on different products. So a normal retail shop, right? Walmart would do this, right? They would buy low and sell high, right? So how are they inflating it? I mean, I will talk about limit orders and whatnot. What is fair price? Fair, you know, that's a good. It's difficult to say what fair price is, but fair price is something that you deem that this is the correct price of an asset with respect to the monetary unit, right? If I am selling, say, apples, right, the fruit apples, so if I'm buying them at $10 for 1 pound, right, then I'm buying it because I think that is the fair price, right? Something like that. So it's It's what I deem to be the correct price of that asset for that particular time, right? We will, as I said, I will not talk about calculating the fair price right now, but in due lectures, any strategy you would understand how to calculate fair prices, right? Especially in the lectures and options and whatnot. All right. Yes, fair price is sort of individuals' judgment for that particular time, and future tells whether their fair price calculations are correct or wrong. All right. So is liquidity clear? Was liquidity clear? Yeah, fair price for that particular stock per share, of course, right? Difference between market takers and makers. So I already discussed makers. Market taker would be, so this guy, this Nitin guy, order number 10 is a market taker, right? Because he reduced liquidity, right? He took some volume away from the market. So that's a market taker, right? All right. All right. So this is an order book system. So this is for S&P 500 ETFs. So you can have, so this is how a book can look like. So you can have them horizontally, vertically. So on NSE, I showed you it was basically a representation, a horizontal representation of the order book. This is sort of a vertical representation. It's basically the same, right? So top of the book says low, so highest bid, right, would be at the top of the order book, right? And lowest ask would be at the top of the book, right? So bids would be decreasing in terms of the price and asks will be increasing because the highest bid would be the first to trade. If a market taker comes in the market, then the highest bid would be executed first. And I will talk about matching engines and whatnot. But this is how an order book system looks like, right? So 6,400. There's somebody, there's some people who want to buy 6,400 shares at a price of 180.02, and somebody who wants to sell this. So let me just do one more thing, because I really want you to understand how an order book is created and everything. So let me just give you some instruction, and then so these are the orders. Buy order at buy order for 100 share at, say, uh, 25,000, right? And then sell order at for 50 at I would say 25,050. There's another buy order. There's another buy order, and then there's another sell order, right? So this is at 930. This is at, say, 945. This is at 950, at 955, and then say at 1050, right? So say this was the time, and these were the orders that came. So let me just change this slightly. So say 20, and then say 200 at 25, 10, and then sell order for 10 at 25, 25. So if this is the case, then how will my order book look like at each of these times, right? All right. So right now I will talk about different order types and hidden and iceberg orders and whatnot, but in some time, right? So right now I'm just assuming that These are all normal orders that are sent to the exchange, right? So how would the order book look like at all these times, right? So this is the bid. So you can, feel free to sort of, so this is the price, this is the quantity, this is for ask, this is the price, and this is the quantity. So at 9:30, what will happen? 125,000. All right. So, and there is no ask, right? So there is no ask. Then at 9:45, a sell order, the bid order remains the same, right? So this is the order book at 9:45, right? So at 9:45, the bid remains the same, but the ask changes to this, right? Let me just save this so that, okay. All right. So then this is what happens, and then so on, right? At 9:50, there's another buy order. So the quantity would change and the price would remain the same and the ask would remain the same, right? So I hope you guys can appreciate this. Only the quantity changes, the price remains the same with this order, right? And then so on. So this is how an order book is built. Is this clear? Yes. So these are all ticks. So this is tick 1, tick 2, tick 3, and so on, right? Is this clear? I will not cover FIs and DIs right now. All right. Everything is clear so far? Perfect. Perfect. All right. Great. So far so good, right? So you know the order book system. So, as I said, orders are usually sorted in ascending order and descending order and whatnot. Tick is any order that reaches the exchange, right? So this is the order book. So you have bids and you have offers and whatnot, right? All right. There's a question. So I have not discussed matching orders, right? So please, I'm not discussing how exchanges match the orders right now, right? I will discuss it. Be a bit patient, right? I will discuss everything, how they are matched, and there are different matching systems. Let us see what is happening here. So this is saying that you want to buy 100 shares and the max. So okay, now comes the matching system. So okay, let me just talk about matching system now. In a fair and properly functioning market, you as the buyer would receive the lowest offer. If you wanted in this order book, if you wanted to buy 100 shares at 50.2, you will get your you will get your trade at 50.1. All right. So in a fair and properly functioning market, you as the buyer would receive the lowest offer that the market can provide. So in this case, the lowest ask is 0.1 lower than your limit, which is a good thing because you get the share at that particular price. Is this clear? This system of the best bid and best ask would guarantee you the better price. So if you place an order for a buy or a sell, and there are existing orders in the order book that offer you a better price for your trade, you will get a better price. As simple as that. And let me introduce you to the concept of price time priority, right? So there's something called the price time priority. So you guys would So, and there are different matching systems, but let me discuss. What does this mean? Price, time, priority. If you have a better price, and what is a better price? Better price for a buy means higher price, right? Higher price. Better price for a sell means lower price, right? For a sell would mean a lower price, right? So price time priority means that first the exchange will look at my price. If my price is better than all the other traders, then my order will get priority. If two orders of the same price enter the exchange, then the order that reaches the exchange first will get traded first. Is this clear? So bid and ask, my friend, this is how, so you are bidding for it, right? You want to buy, and ask rate is you want to sell it. So I don't know if you've sold a house or anything, right? They'll ask you what is your, if you are selling it, what is your ask, right? What are you asking? And if you are buying it, then what is your best bid, right? So bidding is for buying. Anyways, better price for a buy means higher for the exchange. This is for the exchange. So exchange will consider your buy price better if it is higher, right? Is this fine? So people are asking me to repeat price time priority. Price time priority simply means it is a matching system, right? It simply means that if I have to, how will the exchange know which order to trade, right? So they will first match the price. Whoever for the buy, whoever has the highest price, that price would get traded first, right? For an ask, whoever has the lowest ask will get traded first. If there are two orders at the same price, right? Two buy orders at the same price, then the order that hit the exchange first gets traded first, right? So first it is price, then it is time. Is this clear? Better price for the exchange, my friend. So with price time priority, your order will get traded first if you have a better price for a buy, and better price for a buy is if you have a higher price. This is not for profitability. Yes, for profitability, better price would be as low as possible, right? I mean, if an asset is worth $100, I would want to buy it at $1, but that's not a good price for the exchange, right? Because for there would be no seller at $1. So the exchange, it really won't care about your order, right? I mean, it's for an exchange, it is as high, a high buy is better, right? If both the orders are placed at the same time, in this world, my friend, nothing is simultaneous. So think about it in terms of an exchange, right? The exchange has a program that is reading instructions, right? It cannot read two instructions simultaneously, right? So there is, and these guys have a have an uh, lowest count of in nanoseconds, right? Or even if they had it in microseconds, it just doesn't matter. Nothing happens simultaneously, right? So it's literally impossible for two electrons, right? These are all electronic signals, right, to reach the system. And even if they reach the system, whichever order the system read first will be timestamped before the previous order, right? Yes, so the lowest price seller will get matched with the highest price buyer. So if this was the case, so this is trader 1, trader this was trader 2, this was trader 3, this was trader 4, and this was trader 5. Now, I hope you would be able to appreciate this fact. So the order book at, oh my God, what did I do? So the order book at 10:15 is something like this, right? It's something like, so we have, and you have 200 here, 25010, and you have, so I hope this part is clear, right? This is what I've been talking about, the order books. So this was clear, right? Right. Now say at 10:30, a trader, says trader 6, fires an order, fires a sell order for 10,400 for say 300 shares or 250 shares. What will happen? Can anybody tell me what will happen? How will the order book look like, and what will be the trade that will happen? Nothing will happen. Hey, dude, sell order for, oh, sorry, for 25,400. I'm sorry. All right, for 25,400. All right. So 250 shares. So what would be the trade? Any guesses? So the trade would be, let me just hide this. So the trade would be, trader 6 will get 200 shares at 25,010, will sell, and trader 4 will buy 200 shares at, so this is the match trade, right? Matched trade. This would be the match trade for the first 200 shares. Is this clear? Oh, sorry. Oh my God, what am I doing? Oh, wait a minute. 20. Okay, does this sound better? Does this sound better? Yeah. Perfect. Yeah. All right. So if trader 6, so this order book was clear to you guys? Yeah, this order book was clear to you guys. At 10:30, trader 6 fires a sell order for 24,500 for 250 shares, right? The match trade at 10:30 would be, the trader 6 will sell 200 shares at 25,010 because this was the price time priority, right? So this guy had a better price. So trader 5 had a better price. So sorry, trader 4 had a better price, right? Trader 4 had a better price, buy order for 25,000 10. So he will buy these shares. Trader 6 will sell these shares to this guy. And there would be another trade because there were 250 shares. Trader 6 will sell another 50 shares at 25,000, right? And trader 1 will buy 50 shares at 25,000. Is this clear? Is this clear? Anybody who did not understand this? So I will tell you limit orders and market orders, but let us just don't get into that terminology right now. I just wanted to share these things. Trader 6 is not selling at a loss. He is selling at a better price, right? He wanted to sell at a lower price, but he's getting a better price, right? He's selling at 25,010, right? He wanted to sell at 24,500. So what do you want me to repeat, guys? So okay, let me just repeat this whole thing. Was the order book clear? Was the order book clear at 10:15? Anybody who did not understand the order book till 10:15? All right, clear till 10:15, right? So now at 10:30, trader 6 fires a sell order for 24,500 for 250 shares, right? For 250 shares. Now, as soon as this order hits the exchange, remember price time priority. The best price for the best bid will get traded first, right? Best bid means highest price will get traded first. So trader 4 had the highest buy, right? The best buy. So he will get his shares will get traded first, right? Now, why didn't trader 6, why did trader 4 get a worse price, right? I mean, he could have got it at 24,500. This is not, so remember, in fair and properly functioning market, you as the the person who wants to make a trade, right? Who wants to make a trade gets the best price possible. So there's an existing order book, right? And if I want to trade, if I want to make a trade from that order book, right? I want to remove liquidity from that order book. I get the best possible price. For a buyer, if I'm a buyer, I will get the lowest price irrespective of whatever at whatever price I want to buy the asset at, right? If I'm removing liquidity, if my order is initiating a trade, as a buyer, I will get the lowest price. And as a seller, I would get the highest price, right? So this is how exchanges work, right? Yes, the seller, both of them want to make the trade, but who the order for trader 6 will initiate a trade, right? So whoever initiates the trade, right? So at 10:15, there was already a bid. The trader 4 had already placed an order for 25,010, right? He wanted to buy. So that's already there. Now, whoever wants to make a trade, he gets the best possible price for him, right? For the seller, the best would be higher price. For a buyer, it would be the lower price, right? So a trade happens at, so when I say best, the trade price is best for the buyer and the seller, right? Not for the exchange, right? Is this clear? order is an instruction to make a trade, but it's not necessary that all orders, as soon as they hit the exchange, they will initiate a trade, right? There are some orders that as soon as they hit the exchange, they initiate a trade, right? So at 9:55, when the trader 4 fired an order, that did not initiate a trade, right? But at 10:30, when another trader 6 came, that initiated a trade immediately. Is this clear? All right. This is how a matching engine works, right? And this is how people deem it to be fair, right? Why did order took place when the price did not match? I didn't understand that question, Ravi. Can you just explain that question? I mean, I really didn't. What do you mean? Why did the exchange take that order when the price did not match? So order book is always generated even if the price does not match, right? A trade will get initiated when the price of a seller and a when the ask crosses the bid. It's not always that it has to be exactly the same, right? Whenever the ask crosses the bid, a trade will happen, right? Or a bid crosses the ask, a trade would happen, right? Not necessarily it has to be exactly the same, right? So that's what I've been trying to explain you, right? Why did trader 6 get a better price than trader 4? Because trader 6 order initiated a trade, right? When trader 4 fired an order and it hit the exchange, a trade did not happen. So whenever you fire an order from which a trade would get initiated, you will get the best price. This is how matching engines work. All right. So, and the important point over here is it is trader 1 who will buy 50 shares at 25,000 and not trader 3, right? Because trader 1 order was placed before trader 3. Is this clear? This is what the price time priority means. Any questions? Any questions? Yes, the exchange. So there's a question. This means that the exchange has a way to determine the time of each order. Absolutely. Absolutely. The exchange maintains a timestamp for each order. And these are pretty sophisticated engines actually. All right. There is other schemes also apart from price time priority, and I will take them further in the class. All right. All right. Perfect. So now that you've understood this is the highest bid is. So highest bid is called the best bid. Lowest offer is the best offer. I told you difference between the best and the ask and bid is the bid ask spread. So liquidity can be thought of as a service that you can buy or sell, right? So higher the volume, higher the liquidity, right? Trader 4 bid was higher than trader 1 bid. So why was trader 4 take executed first? Because this is what price time priority does, right, guys? Better price. So exchange will match better prices first. And better price for the exchange is, for a buy, it means higher price. For a sell, it means lower price. Yeah, so obviously lower, so lower the spread, higher the liquidity, absolutely. But, the bid ask spread is also a function of volume, right? If there's higher volume, there would be less bid ask spread, right? Because there'll be a lot of people who want to just buy and sell, right? All right. Perfect. So I'll just take a break after this. Now, there are two main mechanisms uh, in which trading happens. One is auctions and one is continuous. So right now, all the examples that I was showing or giving you were examples for continuous trading, where everybody knows what the bid and the asks are, right? The order book is publicly displayed, right? So it's pretty transparent in that sense. There's a second market mechanism called auctions. Now, or auction not in the literal sense, but something in the sense of initial public offering, right? So say I'm a private company and I want to go public, right? I want to raise public money, right? And I want to sell my shares. So what happens in that sort of a mechanism is, I would go and consult an investment banker, and he would pitch my company to different buyers, right? And each buyer would give me a bid, right? Would bid uh, for the IPO, right? And then whoever has the highest bid gets the part of my company or share or equity, right? So in this case, right, if there was say 10 buyers, right, none of the buyers know what the other person's bid is, right? It's sort of very opaque, right? They don't really know how much did the other buyers bid for my company's shares, right? So in that sense, it is they're sort of bidding for my company without knowing what is the best bid available in the market currently. So it's very opaque in that sense. Excuse me. uh, these sort of systems can be manipulated, right? If the buyers come together and they discuss it, it's quite possible that they reduce there can be a lot of they can sort of make unions and decrease the price and whatnot, right? So obviously continuous trading is provides the best price for the asset, right? Because everything is very transparent, and there are so many buyers and sellers that they cannot really make unions, or oligopolies for that matter cannot happen, right? They cannot communicate with each other and decrease or increase the price in that sense, right? So auctions are the norm in the primary markets, right? So initial public offerings, or if there's the merger or an acquisition or whatever, right? And these sort of things, auctions are the norm, right? And they're pretty opaque in that sense, right? But in continuous markets, potential buyers notify the other participants of the maximum price at which they would be willing to buy the asset, right? All right. Now, so one of you guys is asking me what is a bulk deal. I don't know where you read it, but I've not discussed a bulk deal. So let us, contain our questions to what is being taught, right? It's better that way, right? Example of an exchange that works on an auction was, so in a secondary. So all these exchanges, right? NSE or uh, any BSC or any other exchanges in the uh, uh, in different countries, right? They're mostly secondary markets, right? So they can buy and sell in the secondary market, right, with the help of that exchange. So secondary markets usually don't have auctions as mechanisms for trading, right? It's usually when in the primary markets, when uh, when a company offers their shares for the first time, right? That's the primary market, right? Yes, all HFT, algo, these are all secondary. They're never initial public offerings, right? So over, all right, you know, so there are some trades called over the counter. So, and okay, I'll just take, there was a question about the bulk deal, right? So, if there's an institutional investor, right, and they want to invest a huge amount, right? They want to buy, say, shares of Apple, right? And they want to buy 1 million shares. So that's a bulk deal, right? Now, obviously, if they come on the secondary market, then, and if they immediately put such a big order, right, they might not get a great price, right? Because there's not so much of liquidity, right? I mean, uh, for 1 million, they would have to remove a lot of liquidity in the market, right? So what they can do is they can actually have a trade between a potential seller. So say, they find a seller who wants to sell shares worth 1 million, right? So they would have an agreement at a particular price, and then they will just inform the exchange that this is the deal that we've had. We are buying 1 million shares worth $1 million at this particular price, and the exchange will just disseminate that information in the public. All right. All right. So this is, I mean, usually when auctions take place in the secondary market, they don't happen at the exchange level, right? So a buyer would find a seller through a third party, not necessarily the exchange. They might find it through an exchange, but they sort of have an agreement outside the exchange, right? And they just inform the exchange that this is the deal that we've made, right? Can HFT manipulate the prices? No. I mean, that's the best. I mean, no, manipulating prices is illegal, right? So nobody should be allowed to manipulate prices. All right. So if a buyer comes with an unconditional order to buy, right? That's called a market order. Now, let me just introduce you to the concept of. So are the two market mechanisms clear? Auctions and continuous trading? Yes or no? Why do the two parties who made an over-the-counter trade required to tell the exchange? Based on different regulations in different countries. So, the regulatory board just makes it a point that that deal is made public, right? So that the public knows that this has happened, and the uh, exchange is the best way to sort of publicly disseminate that information. So it might be a regulation in some countries, it might not be a regulation in some countries, right? So it really depends upon the regulation, but usually exchanges are informed, and that is how the deal goes through. How does the matching happen in an auction? The best bidder gets so if you are buying, the best bidder would get it. If you're selling, the best the highest, so best bidder would be the person who bids for the highest price will get the shares, and if you're selling, then whoever asked for the uh, uh, for the uh, for the lowest price would get it, right? And then again, I mean, there are different, so I will discuss different matching engines, right? So I've already discussed, if the volume that would initiate the trade is higher than the best bid or the best ask, then this trade happens in a succession, right? All right. Now, the smallest interval between two prices is fixed by the market and is called the tick. This is different from the tick by tick data. That tick was different. That tick is simply an instruction to the exchange, but the same word tick is also tick size. Usually this tick is is called the tick size. What is the tick size in the exchange, right? And that is the smallest interval between two prices, right? That is basically, so for example, and I'll just share with you an interesting study. So for example, in India, you cannot, if I want to buy, so if I want to buy this Gujarat State fertilizers, I cannot buy it at 93 rupees 81 paisa, right? The smallest tick size is 5 paisa. So I can only send my orders with prices that are rounded till 5 paisa, right? So I cannot do it in 93. I cannot send an order for 93.82 or 83, right? It's either 80, 85.90 and whatnot. So in intervals of 5 paisa, 5 cents for that matter, right? So that is called the tick size, right? In a lot of US exchanges, the lowest tick size is 1 cent, right? Now, there was a very interesting study. This is, yeah, there was a very interesting study on the tick sizes. How does, so tick size pilot program that was started in the US for some exchanges. So, this program, basically, the goal of the pilot was to study the effect of tick size on liquidity and trading of small capitalization stocks, right? So, usually the tick size is 1 cent in the US, but for some stocks, they change the tick size to 5 cents, to a nickel, right? For some particular specified securities, because they wanted to sort of see the impact of tick size to liquidity and trading volumes and whatnot, right? So tick size has an effect on volatility, volumes and whatnot, right? So this is what a tick size is called. All right. So you know what? Let me just take a 5-minute break over here, and we'll continue at, so it is 5:39, 5:38 by time.is. So we will reconvene at 5:45. All right. And I'm still here. I can take questions, whatever were left, right, unanswered. Who determines the tick size? It's the exchange. Exchange would determine the tick size. Guys, you can hear me, right? All right, perfect. Why is the open price? So there's a question. Why is the open price different from the close price? Yesterday's close price. My friend, because there might be, so let me just give you a simple example, right? Say there's a all right, so say there's a oil company, right? And it has a lot of oil reserves, right? So say on Thursday evening, it closed at a price of $100, right? Now on Thursday night, they found another oil reserve, right? I mean, they were drilling for oil and they found another oil reserve, right? So that's good news for them, right? So if they closed at a price of $100, the price would open at higher than $100, right? Because now the company is worth more, right? So the open price is would be indicative of the price after that discovery has been made, right? So maybe it will open at 110, 115 or whatnot, because that's a good news, right? So, and just to give you another example, so if say on Thursday evening, right, after the markets have closed, there's some news about, say the Fed increased the interest rates and whatnot. So it affects the markets, right? So all these effects would be then reflected in the open price of the stock, right? Is this clear? Could I repeat what you said before, the tick size concept? So I was just explaining the market mechanisms, right? Just the auctions and continuous trading, right? So auctions are frankly not important for us, right? We would mostly all the exchanges that we would trade would be continuous, right? All right. So you can read about what was the result of the study. So you can, we'll share you the links and you can sort of read it yourself, right? Market maker get commission from exchange. There are a lot of incentives given by some exchanges to market makers. So, for that matter, anybody who's providing liquidity, and market makers usually provide liquidity, there's some incentives and rebates. From time to time, exchanges would give that, but it's not that they always get some incentives, right? So it depends upon the exchange and, uh, how they are, how they would want to generate liquidity, right? Yes, but there are some rebates that have that do get offered, right? Does the stick size of the instrument change after getting listed on the stock exchange? It might not. It just, as I said, for this pilot program, the tick sizes were changed for some stocks after they were listed and they had been trading on the exchange for quite some time, but still the tick size was changed. So it can happen. From an order book point of view, why would the open and close change? See, order book is simply, order book would also be determined by sentiments, right? So if the stock has some good news, I would want to bid at even higher prices because I want to get that trade happen, right? So order book is obviously sentiment determined, right? What is level 2 data? So best bid and best ask is level 1, right? Level 2 is the second best bid and the second best ask. That is level 2. All right. Can we see a sample of order book, including orders placed by algos or any website or software? If you want that, just send me an email. I'll have to search for an example, right? I'll have to search for an example. What does tick size mean? It is the minimum, the smallest interval between the two prices. So as I said, right? So okay. So say there's a bid at 93.25 for this stock, right? Or let me just use Bank Nifty, right? So there's a bid at 25,351.00, right? Now I can only send orders which are rounded to 5 cents, right? So I cannot send an order at 25,351.1 paisa, right? 0.01, because exchange, all the exchanges, they determine a tick size, right? For NSE, the tick size is 5 paisa. So for any order, the price has to be rounded off to 5 paisa. So I cannot send it at 1 paisa, 2 cents, 3 cents, 4 cents. It has to be 5, 10, 15, 20, right? So 5, because 5 is the tick size, right? When is the best price for exchange executed? When there's a matching trade, right? When there's an if there's a best bid, right? That so there's a best ask and best bid, right? So if there's a buy order that crosses the best ask, right, then a trade will be initiated, right? is someone like an interactive broker also a market maker? Brokers are just intermediaries for traders to connect with the exchange, right? I mean, interactive broker might run their own strategies, I don't know. But in their functioning as a broker, they're simply, they earn out of commissions and not out of the bid-ask spread, right? So it's 5:45, so we should reconvene, right? I'm just answering a couple of questions. All right. If an order is not filled on the day, does it automatically get carried over to the next day? No, not really. If the order does not get executed in the day, then it would be cancelled, and you'll have to place another order the next day, right? So Carlos, it would be great if you can email me that, and we will share it with the students, right? So one of our friends, students is saying that he can provide a picture example of an order book from software books, MOPA and whatnot. So it would be great if you can sort of email, and we'll share it with the class, right? Thank you so much. What is meant by indicative price? I don't know. I mean, so I mean, I in the context of order book, if you are, I'll have to get more context, because indicative price is used in a couple of contexts. So, you'll have to give me some context, right? So, okay, let me just continue with my lecture so that we don't get left behind, right? And whatever questions were sort of out of context and not answered in the break, I will take them either offline or after my lecture, right? All right. Is dealer a market maker? I don't know what you mean by that. I mean, it's not necessary that a dealer, I think dealer and traders are interchangeably used, right? All right. So this was the structure of the order book, right? It gives you a list of all buys and sell orders with their corresponding price and volume, right? So I think I've covered all these points, right? All right. So, a lot of strategies are made based on order book, right? So what people will do is they will sort of, depending upon how, so if I just see this order book on the slide, right, there are more sellers, right, than buyers at this price 5252, right, than 5250. So if just giving you an example, a lot of people would take, if they're asked what is the fair price, they can just take an average of the best buy and the best ask, right? So that is a fair price. But my opinion, and this is only my opinion, this is how I think of, so, or a lot of people think, so if a trade happens at 5252, people would think that, what, that is a fair price. So they think that last traded price is a fair price, right? Or the average of the best bid or best ask is a fair price, or a weighted average. So some people would think that, a weighted average. So 5250 into the buy quantity plus 5252 into the sell quantity divided by the buy plus sell quantity. The weighted average is the fair price, right? So there are a lot of great debates on what the fair price is at one particular time. So if this is the order book at say 10 a.m., right, and the last trade happened at 5250, right? So people would be like, some people would say, no, the fair price is 5250. Some people would be like, no, the fair price is the average of best buy, best ask is the volume weighted average and whatnot. The Ravi, I would really request everybody to please ask questions related to what I'm teaching, right? It really disturbs the flow, right? And I'll be more than happy to answer all the questions offline, right? But please let us stick to the lecture, right? So there's a lot of debate on what is the fair price. In my opinion, fair price is anywhere between 5250 and 5252, right? There's a probability distribution curve between 5250 and 5252, and the fair price somewhere lies between. It is definitely not, for me, it is definitely not the trade price. The reason is because, if a trade happens at a particular price, right, there has to be one person who would get a better deal and the second person who will get a worse deal, right? So a trade will only happen with some extra information. If everybody had the exact same information at that particular time, no trades would ever happen, right? No trades would ever happen because nobody would want to waste their money in transaction costs, right? There are transaction costs. So if God tells me that the fair price of this asset is 5250, I would never want to buy it at 5250, right? That's the fair price. I would want to buy that asset at slightly lower price, maybe even at 5249.95, right? I mean, lower than the fair price because there's some money that will go in the transaction costs, right? Brokerage and whatnot. So a trade price for me is never, I mean, this is only my opinion, right? People have different opinion. As a trader, I have my own opinion. So I'm just sharing my opinion. Don't, take me to the court for this opinion. But this is how I look at the order books. So for me, fair price lies anywhere between the best bid and the best ask. It might not be the average. It might not it's definitely, for me, it's definitely not the traded price. It's somewhere between, right? With a distribution, right? The mid is not always the best price, right? All right. No, you don't have to apologize for anything. It's all right. So the structure of the order book, there are a couple of interesting papers that that I just might want to share. I will share these papers. So statistical properties of stock order books, you can actually go through this. This is an interesting paper, right? And they talk about, so this is a histogram between the prices and the number of orders, right? So if this is somewhat so on the x-axis you have the, say, the price, on the y-axis you have the frequency. So this is how an order book histogram would look like, right? There would be highest orders around the best bid and the best ask, right? And then lower you go for bids, there would be less orders. Higher you go for the ask, there would be lesser orders. So this is how the histogram looks like, and you can go through this paper. I just wanted to, there's a lot of work that has been done on this, right? I will share this PDF, right? So don't worry about it. I will share these things. So this is the average shape of the book, right? Sort of normal distribution, and we will study these distributions, right? All right. So you can sort of, so order flow is maximum around the current price, the best bid and the best ask, right? Obviously, orders that are near the current price have a larger probability of getting executed. So obviously, right, if I look at this order book, right, where is my order book? Did I lose it? So yeah, so this was my order book, right? So obviously, if a bid comes at 23,000, the probability of it getting executed is pretty low, right? With respect to an order that comes at 25,025, the probability of that getting executed is higher, right? Because it is very close. The closer it is to the best bid or best ask, the better probability, right? Guys, I will share the document, right? So don't worry about that document. All right. Okay. Any questions? So you can read the paper and log why have they taken log? I mean, it's a pretty decent paper. They've explained why they've taken log and whatnot, right? I mean, it's just that the distribution was better formed when they took a logarithm, right? That's how they could model the distribution. All right. So any questions on order books or how the order book is created, best bid, best ask? Everything is clear? Yeah? Great. Great. I hope the speed is all right for you guys, right? I'm trying to get everybody on board, right? So I usually try to answer any question, that is important for the discussion in the lecture, right? All right. Order routing, right? So, as markets have become more and more complex, I think order routing has become a major factor, right, in getting the best possible prices. Now, how your order is routed to the exchange and what happens during this routing is of major significance, right? How you place your order, right? What type of order do you place? Yes, there are other matching algorithms, and I will discuss those matching algorithms. Price time priority is the most important algorithm in my opinion. So I discuss that first. I will discuss other matching algorithms as well, right? So what is order routing? So I've already discussed this price time priority. Orders that come into the market have been placed in price time priority. Best price is always first in line. And for orders of equal price, the orders that have come in first are ahead of the queue for that price, right? So just an example. So I've already gone through this, but you place an order to buy 400 shares at a limit 49.9. The 600 shares that were in the book before will be in front of you, and when they get to be the best bid, right? So obviously, so I've discussed everything, right? First price and then time and whatnot, right? So I guess, yeah. So now I'll start with type of orders. Very important. What are market orders, right? Market orders are orders that will get executed as soon as they hit the exchange, right? At whatever the best price currently is available in the market, right? So market orders are those orders which will get immediately executed, right? So for example, this order of trader 6 was a market order, right? Because as soon as it hit the exchange, it gets executed, right? So that's a market order. Yeah, there are a lot of strategies. So, again, let us keep our questions to what is being discussed. But just email me. We can discuss strategies based only on order book, right? So, for market orders, execution is most important. Whatever might be the price, I just want to buy it, right? It usually fills very quickly, but obviously you might get an inferior price, right? Because they are used by sort of impatient traders. So, so it's quite possible that now this trader 6 fired an order at 24,500, right? So he got a trade at 25,010 and 25,000, right? It's quite possible that had he waited for 15-20 minutes, he could have, the price would have risen and he could have gotten a trade at 25,025, right? But obviously there's a balance between you getting an inferior price if you hit a market order versus the probability of getting executed. So it's quite possible that, you know, the order, so this trader 5 placed an order at 25,025, right? If the market is crashing, it's quite possible that trader 5 does not get a fill, right? So there's always this conflict. All right. So ma- some of the participants are saying that you cannot mention a price. This is equivalent to a market order, right? This is sort of equivalent to a market. It will get immediately executed, right? Yeah, I mean, usually market orders will not have a price, because whatever is the, if I'm selling, whatever is the best bid, I will get a trade there, right? But this is, I mean, uh, as an example, this is sort of an market order, right? Because this will get traded immediately, right? Right. So you obviously pay the bid ask spread, unlike the market makers who always, you know, who are sort of near the best bid and the best ask, and they hardly ever cross the bid ask spread, right? So obviously, you know, market orders, a trader who's sending a market order is willing to pay that bid ask spread, right? And you know, he basically reduces liquidity, right? Because he takes away the liquidity from the market, right? So traders who submit large market order often pay more than half the bid ask spread for liquidity, right? I mean, these orders would be used for traders who immediately want to get a fill, right? And they're very impatient. I mean, at any cost, they have to get executed, right? Obviously, the execution price is uncertain. It is quite, so, you know, it is quite possible that at 10:30, this trader fired an order, you know, a market order for sell, and at 10:30 and 1 microsecond there was another order that came for a you know, and probably this trader 4, just before trader 6 could, you know, trader 6's order could hit the exchange. It is possible that trader 4 removed his order, right? So it's quite possible that the trade would happen at 25,000, right? So it might be different from what you are seeing at this screen, right? So market orders will always have some uncertainty in the price, right? So if this is the order book and you want to buy 100 shares now, you would get those 100 shares at 50.1, right? And then the order book, so you remove liquidity 50.1, and then the order book will shift to this. The offers would move to, from 50.1, this is removed, and the 50.15 would be now the best offer. Is this clear? I've all now, I hope everybody can answer this question. What will happen if you wanted to buy 500 shares? Guys, what will happen if you wanted to buy 500 shares? What would be the price that you will get? So you will get 100 at 50.1, 200 at 50.15, and another 200 at 50.2, and 9,800 would be left at 50.2, right? Yeah. So the size was 10,000 at 50.2. So you will not move more than 50.2, right? Your worst price for you would be 50.2, and you will get 200 fills at 50.2, right? Great. So everybody understands this. Now comes the limit orders. What are limit orders, right? there's a question, will it be the same? Yeah, so this is about, so this is sort of a market order, right? So if I place a market order for 500 shares, I will get it at 50, I will get 100 at 50.1, 200 at 50.15, and 200 at 50.2, right? Yeah. Now what are limit orders? Limit orders specify the price. So if I want to buy, they specify that, you know what, I want to, the worst possible price for me is, so if this is the order book, so I will say, you know what, I want to buy 100 shares at 50.05 and nothing more than that. If I get a lower price, that's fine, right? But I don't want to buy at a price greater than 50.05. So that is a limit order, right? Best price, if it is no worse than the limit price. So I will not buy at a price more than my limit price, right? So if no trader is immediately willing to take the opposite position, the order will not trade and it will get reflected in the order book, right? So here, if I, in this example, if I wanted to buy 100 shares at 50.05, so there's no ask at 50.05. So my order book will change to, so this is the bid, quantity, price, ask, quantity, price. So what was it? So 350, so 350 and 150.1, 150.1. So if a limit order is fired for 100 shares at 50.05, this order will not get traded and it will be reflected in my order book like this. So now my best ask is this, my best sell is this, and there are 300 shares at 50 bucks. Is this clear, guys? Yes or no? Which order gets highest priority, limit order or market order? Guys, matching engine doesn't care about a limit order or a market order. It only cares about the price time priority. If the engine is working on price time priority, then it only cares about the price time priority. For it just doesn't matter whether it's a market order or a limit order or whatnot, right? So just to be clear, let me ask you a simple question. So what was the order book? 49.95. This was 100. 50.15, 200, right? 50.15, 200, 250 point. So you know what happens when a market order was sent at for 500, 50.2, right? For 500 shares, right? This was a market order for 500 shares, right? So if a market order is sent for say 300 shares, right? Then this is what will happen. So you have 50.2, right? Your order book will look something like this. So 50 This remains the same for 300 shares, right? So your order book will look something like this, right? Is this clear? I hope this is clear. However, if a limit order is sent for 300 shares, if a limit order is sent for 300 shares, for limit orders, you have to specify a price, say 50.15. Or, let me make it 400 shares or 500. I'll take the same example, right? Or, yeah, right? So then this becomes 9,800, right? If a limit order is sent, then what will happen is, so these would be the trades, right? Trades would happen 100 at 50.1, 200 at 50.15, and another 200 at 50.2. However, here, because I did not want to buy anything above 50.15, so 300 shares will get traded, 200 shares would be left at 50.15, and here the quantity would be 1050.2, and these are the trades that will happen. Is this clear, guys? Is this clear? Price time priority, is it uniform across all exchanges and across all assets? It is. If an exchange decides on a particular matching algorithm, then it would tell you that, what, for these asset class, this is the matching algorithm, right? So it might be different matching algorithms might be used for different exchanges, but they will specify it. All right. Is this difference clear? What will happen between a market order and a limit order for 500 shares? Yes or no, guys? So everybody is clear how the order book is changing for a limit order and for a market order? Great, great. Yeah, quantity and price is interchange. Thank you for noticing it. Okay, let me just change it. But you get the idea, right? The idea is more important. All right. The balance 200 will not trade and it will get reflected in the order book, right? So limit orders have control over price. They don't have control over execution, right? They might get executed, they might not get executed, right? So limit orders are placed in a file called limit order book. So this is a limit order book. What we are seeing here is a limit order book. So these people have told us the price and the quantity, and this is their limit orders, right? No, my friend, it is quite, if you send an order for multiple shares, it is quite possible that your order is partially filled. It's quite possible that a limit order is partially filled, right? Absolutely, they will get partially executed, right? So this is exactly an example of a partially executed. Limit order book, no, so a normal order book is usually a limit order book, right? I mean, usually when you see an order book, it's a limit order book, right? Yeah, only price consideration is done in this sort of a matching algorithm, right? So obviously the probability of the trade getting executed for a limit order depends upon the price, right? I told you, the closer it is to the best bid and the best ask, the higher the probability, right? All right. So this is the, so I've already explained this, right? So this is the table, how buy orders and sell orders are sort of classified, right? A marketable limit order is an order that can execute immediately when a trader submits it. So this order by trader 6 was a marketable limit order, right? He had specified the price, so as soon as it hit the exchange, it will get executed, right? So if a buy order is placed above the best ask, right, it will cross. If a buy order is crossing the ask, it is a marketable limit order, right? It will get immediately executed, right? At the above or at the best ask, it is said marketable. Between the current best bid and the best ask, it is called in the market, right? And a buy order or a sell order that is placed between the current best bid and the best ask are called in the market orders. At the best bid, it is called at the market. Below the best bid, it is called behind the market, and similarly for sell orders, right? Right. So this is simple this is the terminology, right? If a person sends a market order, does the person get an incentive from the exchange? Yes, that your trade will get executed. No, I mean, there's no incentive. I wish there were, right? There's no incentive. All right. Not that I know of. All right. Now, third type. So if an order is hanging between the best bid and the ask, isn't that an error? No, why is that an error? That is simply in the market, and it gets reflected in the order book, right? So this order is now between the best bid and the best ask, right? So now, and when it hits, it is now the best bid. So why is it an error, right? So there's a question: if a person sends a best in the market limit order on one side and a market order on the other side, will they get traded? Now, usually exchange does not allow self trades, right? And there's a lot of times there's a penalty on self trades, right? So usually you cannot have a self trade. All right. So a stop order, right? What are stop orders? So let me just give you a simple example. By the way, I hope it is clear to you guys that market orders will remove liquidity and limit orders are providing liquidity, right? All right. So what is a stop order? Stop loss order. It is basically used to manage risks. Now, how is that? How do we take permissions from the exchange to become a market maker? You don't need any permission. It's up to you. You don't need any permission. That's what anybody can be a market maker. Yeah, limit orders that are marketable would remove liquidity. Yeah, that's so. Limit orders that are limit buy orders that are below the best ask would generate liquidity, right? How do limit orders don't pay for the spread? Marketable limit order would, right? So it's not correct to say that Yeah, usually limit order would be, a marketable limit order is usually called a market order. I mean, this terminology is a bit fuzzy. So limit orders are usually called in the market, at the market, or behind the market are usually limit orders, right? I mean, in loose terms, right? Okay. So where was I? Stop orders, right? Why is a self trade not allowed? Dude, if you want to buy and sell the same asset for the same price, why would you want to pay commission? I mean, you will only lose, right? I mean, why would you want to lose on commissions? And I mean, there are a lot of regulatory issues that you are trying to generate volumes, you know uh, unreasonable volume. I mean, why would you want to trade with yourself, right? So it's usually illegal to do that. All right. So there's a question: if best buy order is limit order and on sell side someone placed a market order, will that be executed as the best buy is a limit order? Yes, it will be executed as the best buy at the limit order, right? Do we have to take permission, guys? Again, please pertain to the lecture, right? Do we have to take permission for algo trading from exchange? This is a one word answer, but this is not pertaining to the lecture, so let me not answer this, right? I mean, it would be great for the class. So there's another question. So as the price moves on the price ladder, every buyer orders are filled on best ask or high. So if on the tape there are multiple trades filled over ask, there is high marked order activity come into the market, right? Yeah. So if there's a huge order that is getting traded on the ask side, so obviously a lot of volume is getting generated, right? I think that's what you wanted to ask, Thomas, right? So yeah. So there's a lot of market orders. Market orders will generate a lot of volume. Right? Great. All right. So stop orders. So say stop orders are usually used for risk management, right? Stop orders, or they're also called stop loss orders. Can we cancel limit and market orders? You cannot cancel a market order once it has been placed because it will get executed, right? Uh, you can obviously cancel a limit order that has not been traded, right? So if a limit order has not been traded, you can cancel it, modify it, whatnot, right? Okay. So stop orders. So say we bought an asset at $50, right? We bought the stock at $50. Now so I've already bought this. Now I want to sell it at $55, right? So I've already bought it, say at 10 a.m. At 10 a.m. I bought it at $50. Now during the day, I want to sell it at $55. So as soon as my trade happens, I will send uh, a sell limit order at $55, right? And then wait for it to get traded. But you know, uh, I want to get everything automated, right? So I don't want to look at my screen the whole day. And my fear is, what if the price goes down, right? What if it goes to $40, $30, right? I don't want to take that much of loss. So what I've done is I want to limit my loss to a maximum of, say, for example, $8, right? Right. So this is what I want to do. Now, so essentially what this is saying, so for profit, so for to take profit or book a profit is a better word, book a profit, I will send this order, right? And this is my objective, right? To stop losses beyond a maximum value, right? Beyond a max value, right? So if this is my objective, then what do I do, right? Essentially what this is saying, that if the stock falls down to $42, I want to square off my position, right? I'll take a loss of $8. Now what do? I want to sell only if the stock is trading at $42, right? That is all I want to do, right? So what I'll say, I'll send a stop loss order which gets triggered only if the best ask becomes less than equal to $42, right? So I will send a stop loss order, and the property of that order will be that it will become a market order as soon as the best ask in the order book has a value greater than less than equal to $42. So till the order book is trading like this, right? 50, 51, it will not get triggered. This stop loss order will not get triggered, right? As soon as, if the market is falling and the best ask goes below $42, I will immediately send a market order, and whatever the best bid at that point would be, my order will get traded. Is this clear, guys? Is the stop loss order clear? Yes or no? So this order would essentially make sure that my loss is not more than a certain value, right? The objective is to get rid of the asset if the best ask falls below a particular point. If you're not looking at the screen and the market touches both the sell order of 55 and a stop loss, so obviously you can have instructions that, if my sell limit order at 55 gets executed, then cancel this stop loss order, right? And obviously these will never happen like in seconds, right? I mean, there would be, if there is enough liquidity, these orders will, I mean, they cannot happen in a fraction of seconds, right? So you can have instructions as soon as I hit my limit order, cancel the stop loss, or if I hit my stop loss, cancel the limit order, right? Yeah, so these are separate orders. So this is order 1, this is order 2. This is to book a profit, this is to stop losses, right? Yes, we need to place 2 orders. Are stop losses orders visible in the order book, or is it visible for my broker only? Very good question. They are never visible in the order books. They're only visible to your broker. Your broker will, so see again, this order will not be triggered, and by triggered mean this will not reach the exchange till a particular point, right? So they are sort of kept with the broker, and the broker will immediately send this order if it is triggered, right? So these orders never reach the exchange. This is sort of a property of the broker, right? Yes, if order 1 is executed, then order 2 can be automatically cancelled. Yep. So stop order does not exist on exchanges, somewhat like this, because these stop orders is, they're sort of at the broker end, right? I mean, frankly, I don't know of an exchange if they have a stop loss order. I'm not sure if I mean I know that brokers have it. I'm not sure if exchange gives you this facility. But I know for a fact that brokers do give this facility, right? You can absolutely code this yourself. Absolutely, why not? You don't even need brokers' permission. I mean, you can do it yourself, right? I mean, we do it ourselves, right? Uh, can I discuss about short order on stop? What do you mean a short order on stop? So okay, so if you have sold the option, okay, let me discuss the exact same thing. If I've sold the option, that's fine. So say you have sold the stock. So you want to, during the day, you want to buy it at 55, right? Buy it at 50, at 45, right? So book a profit would be send a buy limit order at 45. Stop loss, I want to limit my loss for $8, then I would send a stop loss order which only if the best buy becomes greater than equal to $58, right? And it becomes a market order as soon as the best buy in the order book is greater than equal to 58. All right. Yeah, stop loss order is linked to a position to limit the losses. How are loss levels calculated? I will discuss this when I'm taking the class on trading systems, right? I will discuss how do we calculate this stop loss levels and whatnot. All right. You can also have a stop buy order to buy at a higher price on the market. This is used to confirm the direction of the market. It's up to you. If you want to do that, I mean, you can have sort of stop orders to book profits. I mean, this is a type of order, right? So I'm just telling you what you can use it anyway, right? Yeah, all right. So thank you, Manish. Right. So one of our participants has given us a link. So NSE actually has a stop loss price order, right? So I usually don't use it through exchange, but probably I will look into it. But we've already coded it ourselves, right? All right. So NSC NSC.India, content equity and trading system. If you search, you'll find it, right? But yeah, I mean, it definitely won't show in the order book, right? All right. So the thing about stop orders is it accelerates price changes, and you will so many times see if there is a market crashing, right? So a couple of weeks back there was a stock called Hind Petro that gets traded on the exchange, right? And there was some announcement and the stock immediately fell by around 25%, right? Like there was some announcement and the stock fell, and you could see that I'm almost certain there were a lot of stop losses that got triggered for different traders, right? And it just accelerates because as the price is falling down, the stop losses get triggered and the market orders for covering your losses get triggered and they remove liquidity again and again, right? So it's sort of a spiral that gets created, right? They unfortunately they contributed to one side demands for liquidity, right? And they accelerate the price in this sense, right? So they sort of add momentum to the market, right? So remember the momentum strategies. So buy when prices are rising and sell when prices are falling, right? So this trading sort of destabilizes the prices. This is sort of a spiral that goes through and a lot of people take advantage of this, right? So I mentioned mean reverting, so contrarian is sort of reverse of that, right? Yeah, DHFL, great example, right? Another Diwan Housing Finance Limited, great stock. So the stock was trading at 550 and and I was I mean my colleague was trading that stock and he just went out for a cup of coffee and the stock within like a minute or two from 550 rupees it fell to around 350 bucks. And when he came back, he was like, am I seeing it wrong or what has happened? Because in a fraction of minutes, it just felt like crazy. So, a lot of stop losses got triggered, right? And he was like, obviously the system was automated. So, I mean, the system did what it had to do. But, for, for a minute or two, I mean, and this is what happens, right? If you're a trader, it will take at least, 15, 20 seconds to sort of assimilate what has happened, right? It's so sudden. And then, obviously we were laughing at the end of the day, but, a lot of traders would have lost a lot of money on that, right? So it's not even funny, right? So automated trading and stop loss orders are very important because, if you don't have a stop loss, it's quite possible that, you can have enormous losses, right? So yeah. Now there are other types of orders. One is the iceberg order. As the term suggests. So by the way, are stop loss orders clear? Any questions on stop loss orders? So when a stop loss order gets triggered, it's up to you whether you want to send a market order to cover your losses or a limit order to cover your losses, right? A lot of people use market orders because, uh, as I said, there's a probability if your limit orders will get executed or not. Your market orders are mostly, uh, you know, uh, there's a very high chance that they will get executed, right? So if the prices are falling and you've placed a order to, to sort of sell it, and the prices are falling, it's quite possible that you miss your uh, price point, right? So it's up to you. It depends upon how much risk you want to take, right? Stop loss orders usually remove liquidity, right? Because once, I mean, they're they if so once the stop loss order is triggered, if you want to send a market order to square off your position, then it removes liquidity. If you want to send a limit order to square off your position, if you want to take that risk, then it will add liquidity, but then the risk still is there, right? All right. So other types of orders are, one is iceberg order. It that so iceberg orders don't show the full amount of order in the order book, right? They're commonly executed using an algorithm, right? So you know uh, an iceberg order in the market would mean that there's a large buyer or seller in that stock, right? And he does not want to disclose all the volume that he wants to trade, right? Because he would want to fill the order throughout the day, right, for as favorable a price as possible, right? But obviously they also have a deadline. So you can send iceberg orders where you only show that if you want to say sell 1,000 shares, you will only show 10 shares or 50 shares, right? Yeah, so depending upon the exchange, you can if your exchange allows these orders, you can send these orders, right? So iceberg order is, you only see the tip of the iceberg, right? You don't get to see the whole volume, right? How do we identify iceberg orders? You actually cannot until you fire an order, uh, right? I mean, so just to give you an example, so say, there's an, so say at 50.1, you have an iceberg order. So the actual price of this is, the actual quantity is say 1,000. So if you send a market order at 50 point, a market order for 500 shares, all your shares might get executed at 50.1 because that was an iceberg order, right? So you will always get, and you would get to know that this was an iceberg order, right? And a lot of high frequency traders sort of fish for these iceberg orders because they know that if somebody has an iceberg order there, then he wants to sell huge amounts of share throughout the day, right? So they sort of there are strategies that fish these iceberg orders, right? Can you hide the entire order? Uh, there are some dark pools and whatnot. So, usually it depends upon the exchange, right? I mean, what sort of uh, possibilities does the exchange allow, right? Who manages the iceberg orders? The exchange manages this, right? Not the broker, the exchange. Can I explain this again? So iceberg order would be, it does not show the full amount of the order in the order book, right? So so the iceberg order would be, you're just seeing the some part of the volume. So if you send a market order, if this was your order book, and you send an, you cannot find iceberg orders. You get to know after your trade has happened that this would have been an iceberg order, right? By looking at the order book and by looking at your trades, that is how you will figure out that, oh my god, this was an iceberg order, right? So as I was saying, if you fire a market order for 500 shares, ideally you would have, so where is this? So ideally, your trades would have been at 50.1, 50.15, 50.2. But what if you get all your trades at 50.1? Then you know that this order at 50.1 was an iceberg order, right? Level 2 order book is, so level 1 is best bid, best ask. So this is level 1. This is level 2, the second best bid and the second best ask, right? So this is level 1, this is level 2, right? All right. So you can read the exchanges protocol to figure out how to place these orders and whatnot, right? So that the prices in order book are real and the quantity may not be. Yeah, so the quantity might not be real or exact, right? But you will, if you're making a trade, you will only benefit from an iceberg order, right? It's not that it's not fair, because you will, a person who is initiating a trade will only get a better price because of that iceberg order, right? So yeah, if an iceberg order gets executed in the opening, then a lot of time, some strategies work on the fact that there would be other iceberg orders on this stock throughout the day. I mean, there are some strategies that people run, right? All right. Uh, Fill or kill, used when you absolutely have to get the full quantity of an order filled at a specific price. So a fill or a kill order, you know, uh, is an order if either it gets fully filled or it gets cancelled, right? So remember when I said that there are some orders that only get partially filled. So if you place a limit order, it's quite possible that you get a partial fill. But there are some, there's a particular order type, fill or kill, where you won't get a partial fill. Either your whole order will get executed or the whole order will get cancelled, right? All right, so there's a couple of questions. In my current data set, this cell level 1 as the current bid, current hours, and level 2 as the complete order book detail in this. Is this a marketing strategy? You know, Usually level 2, I mean, you know, brokers or vendors might have a different terminology, but usually level 1 is the best bid and level 2, level 3, level 4. So, I mean, it's, I don't know. I mean, people might use different terminology, but this is what is usually used in the industry, right? Some people might have different. Frankly, I don't know. There's an order book which we also know the name of institute who buying it. No, order book never specifies the trader's name. Nope, never. Order book only has the order number and whatnot, right? When we are trading on a platform, is the order book of exchange or that is made by the broker? So guys, I told you this, right? The order book is the same for every broker and who's working on a particular exchange, right? So the order book cannot be different, right? Because everybody knows the matching engine algorithm. Everybody knows, you know, the exchange will disseminate which orders are coming to the exchange. So you can create your own order book, right? And if you know the matching engine, you will have the same code as that of the NSE, right? So every broker will have the same order book, right? So you cannot trust the order book quantity. Iceberg orders are not that common. I mean, you know, they're not very common, right? So usually you can trust the quantity on the order book, but yeah, sometimes, you know, you might get a better fill, right? So you don't care who's buying it, right? I mean, you have the asset. If a trade happens, you get the asset in your account. How does it matter to you who is buying it? If it is trader one, trader two, trader three, it doesn't matter to you, right? You have the stock. So there's a question, but the data is not tick by tick, so there can be a delay. So it depends upon the broker, how fast is their algorithm, right? Every if there's one broker might be very fast in figuring out the order book, the second, but you know, usually they are pretty much similar performances, right? I've not seen a lot of difference between two brokers and in creating an order book, right? All right. Is there any cap to maximum quantity to max? I don't think there's a cap, right? And you know, I mean, you can read the protocol of, so all these things are mentioned in the protocols, which is, you know, publicly displayed by the exchanges, right? How to send an iceberg order and whatnot, right? So is an FOK order clear? Yeah, fill or kill would be harder than a limit order price, right? Because a limit order price can get partially executed, partially filled, but a fill or a kill would only get full quantity or it will be cancelled, right? All right. So why am I saying that creating order book for broker? I'm not saying creating order book for broker. I'm saying an order book can be created by the broker, right? By the broker. I mean, not for the broker. It can be created by anybody who is listening to the feed of the exchange, right? If you know what ticks uh, are being sent to the exchange, then you can create your own order books, right? I mean, your own order books in the sense that you don't have to you don't have to ask for a snapshot of the order book. You can create your own piece of code which will make the create the order book, right? I mean, and that order book will be the same for everybody, right? Why do they need to create when it is given by the exchange? Because the exchange, I mean, there are different strategies, right? The exchange might give you a snapshot of only best bid or the best ask, and you might need second best bid, second best ask. So you have to formulate your own order book, right? So it just depends, right? Is the broker allowed to fill the orders with other clients? Yes. All right. Immediate or cancel order. So it is very similar to a fill or cancel, but it's just there's a small difference that an immediate or cancel order, you know, it can be partially filled, right? It's as simple as that. All right. So I just want to cover pegged orders, and then that would be it, right? So Okay. So there are some other, and then I'll take questions after that. Right. So let me just complete this special order types, and then I'll take questions. So there are some aspects of special orders. Hidden volume, I already talked about hidden volume, iceberg orders and whatnot, right? There's another special type of order, which is basically a function of the bid ask spread, right? And exchanges and traders, they just come up with some new ideas of to place orders, as a function of the bid ask spread. So let me just discuss a few of such orders. Pegged orders, right? The order is based on a benchmark bid offer and moves when the bid offer changes. So what is a pegged order? So a pegged order would be, so a pegged order, an example of a, so say, I can send an a buy limit order such that my buy price is equal to best buy plus 0.05 dollars, right? So this is what I can just write a small piece of code, and it will say that, what, I want to send a buy limit order such that my buy price is whatever the best buy is at that moment plus 0.05 dollars, right? And obviously when I say best buy, not taking into account my order, right? So if this is the order book and I have a pegged order in place, then I will send a buy order at $50.05, right? So this would be a, right? And right, so the order book will, after this, the order book will look like, so say I wanted to buy 100, so this is the pegged order, right? And this will always be true, right? Right. So I mean, I can do it best by my, I can do a minus also, right? Minus 0.05. I can make it a function of bid ask spread, right? You see what I'm saying? So it's not always that the pegged order would be the best bid, right? Or the best ask. I mean, I can use it, I can make it a function of the best bid, best ask, or that of the spread, right? So if a market order, if a market order comes for 500 shares at at $50.2, right? And the order book changes, right? So say this happens, right? So my pegged order will be there, but this would change to 9800 and 50.2, right? And then there's a, another person sends a limit order at 50.1, right? Right. So this would shift to 100 at 50.1, and my pegged order would then move right to 50.15, because now the best bid is 50.1. So automatically I will cancel my previous pegged order and it will move to, so I will cancel this order. So this order goes down and I will have it at 50.15. So this is something get modified. All right. Is this clear? This will get executed if an ask comes, right? If an ask crosses the, if an ask order crosses this pegged order price, then it will get executed, right? Benefit of pegged order is that you are always the best bid, right? So your probability of execution increases, right? So yes, obviously you have to make sure that when you are pegging, you don't take into account your own price, because if you are taking your own price, then it will just be a loop and it will finally end at getting executed, right? So you have to peg your order that way. I will share this Excel, right? Yeah, it can be pegged to any bid price, bid ask spread or price and something like that. So right, so it's basically based on the benchmark bid offer, right? So hidden, I've already told you, post only orders are basically designed to gain rebates, right? I mean, they are seldomly used by automated traders, but a post only order would slide a price point away so that it won't execute, right? So if you post an order and it's about to, it will immediately get executed. Okay, so if an order is a post only order and the price of that order is such that it will get executed, then the exchange immediately, it brings the price of that post only order down so that it doesn't get executed immediately, right? So these are seldomly used. I mean, you can read about them uh, you know on the exchanges protocol, but for automated traders, such things are not, they're seldomly used. I mean, if there's a rebate in some exchange, then only these post only orders are executed, right? So post only is an order. It's basically designed to gain rebates, right? It adds liquidity, and the benefit of this post only is that, if you send a post only order and the price is such that it will get immediately executed, right? Then because it's a post only order, by the very design of it, what the exchange will do, it will not get it executed, it will slide the price point away so that it won't execute, right? So just for an example, right, I mean, if this was a, so if this was a, so let me just delete this. So if you send a post only order at say $50.2, right? Then the order book, the exchange will automatically put it at 50.05, right? because it's a post only, it doesn't want to get immediately traded, right? Send up buy post only. All right, so send a buy limit order. So I've already written this, right? All right, So this is post only. So passive agents would be, who put limit orders at bid or the ask, right? Aggressive would be who, who take away liquidity, right? They pay the bid ask spread to the market, uh, you know, uh, so aggressive agent would be who really wants to get their trades executed, right? Their priority is getting the trade executed, right? Passive agent would be, they usually send limit orders around the best bid. They don't cross the bid ask spread to for execution, right? All right, so I've used pegging. So last is discretion order, right? Again, discretion order is usually at the broker's end, right? So the discretion or there's a discretion at the broker's end, right? So this is basically a discretion of the broker. So say I want to send a limit price order, I want to buy at 50, right? But I give them a discretionary range, right? So I'll tell my broker that depending on the bid ask spread, so if the bid ask spread is say 10 cents, you have a discretionary range of half the bid ask spread, right? So if I want to trade at $50, if I want to buy at $50, I'll be fine if you get me a trade at $50.05, right? So that discretionary range is 5 cents. So the broker would be like, fine, I cannot make a trade at 50, but because you had given me a discretionary range of 5 cents, I'll make sure that your trade happens at 50.05. So that is what a discretion order is, right? It's basically the discretion price at which the trader is willing to trade using market orders, right? Is the post only order possible legal? It is legal, and it just gives some rebates, right? I mean, some exchanges give you rebates for increasing liquidity and whatnot, and I mean, frankly, I've never used a post only order. I've participated in firing orders for rebates and whatnot, but I've never fired it, and frankly, these are very uncommon, right? All right, so this is pretty much it for today's lecture. This is officially the end of the lecture. I'm still here for another 5-10 minutes to answer any question that was left answered pertaining to this lecture. If you have questions that are not pertaining to the lecture, please feel free to email me, right? But usually I don't want to take those questions because it just disturbs the flow, right? I'll be more than happy to take those questions offline, right? Okay. Can I please elaborate on discretion order? Yes, absolutely. A discretion order is, you just give, so it is, firstly, it is at the broker's end, right? So say if I want to buy a stock at $50, right? And I tell my broker in the morning that, what, I want to buy this stock at $50 and with a range of say 10 cents, right? So I mean, obviously I would be uh, happier the lower the price you will get me, right? The lower the price you get me, I'll be happier. But my maximum price, I don't want to pay anything above $50 plus the discretionary range, which is 10 cents. So $50 is like good, anything below is great, but the highest I would pay is $50.1, right? Because 10 was the discretionary range, and within that discretionary, I mean, I'll just give a discretionary range so that my probability of getting my trade executed is higher, right? All right. Is the last traded price average or exact at that particular time, because trade happens many times? No, last traded price would be the it would be the, it's not the average, it's actually the last traded price, right? It might change very frequently, but when you get the last traded price, it is actually the last traded price, right? How can a post only order guarantee that the other party will not hit his order? This leads to my upper question. Can anyone? No, so a post only order. So if I hit a post only order, it will enter the order book if it is not getting immediately executed, right? So in my example, where was the post only order? So if I send a by post only order, this is my post only order will get it will reflect in the order book here. And now once it is getting reflected in the order book, now if somebody sends us a sell order, it will get executed. But the only thing is post only don't get immediately executed. That's the only thing, right? Can I explain NVBO national? You please email me because this was not covered in the class, so I'll take this offline. How come post only order is allowed? Because they're creating liquidity, right? They're creating liquidity. So that is why they are allowed. How is it different from limit order? So a limit buy order at 50.2 would have gotten traded, right? It would have gotten traded at 50.1, 50 point. It would have got traded at 50.1, right? But because it's a post only, so it doesn't get immediately filled. It sort of slides down, right? Dude, national best bid offer was not covered, so please let me take it offline. Yeah. In this example, how is a post only order at 50.2 different from a limit order at 50.05? It is not. It is not. In this example, it is not. But you can see the benefit of a post only order, right? Because between the time you send an order, there are the best bid and the best ask can change, right? So the only benefit that you get with a post only order is that it won't get immediately executed, right? But yeah, in this example, there's no difference between a limit order excuse me, a limit order at 50.05 and a post only at 50.2, right? Dude, so this is all that I wanted to cover. I will, whatever is left, I will cover it in the, so I told you, right? I will cover only these 35 slides, right? So 30, yeah. So this key strategies and ideas will be covered in the next lecture, right? For an iceberg order, it is only one way or bi-directional. So Akshay, I didn't understand your question, right? So one way or bi-directional. So I can send an iceberg order, a sell iceberg order, right? It would be one unidirectionally. It's just that the only difference between a limit order and a iceberg order would be that my volume would not be fully disclosed, right? It would be undisclosed, right? So it's pretty much that. Once the post only order enters the order book, it will get executed, obviously. So all these slides that are left would be covered in the next class. All right. Offset and match topics is also not covered, dude. So when I will cover offset and VLOOKUP in my trading systems class, right? So don't worry. Please don't worry about all these things, right? I mean, I've been taking these classes for quite some time now, so I know what to cover and when to cover, right? So don't worry about it. Yeah, we are covering the next strategies next week. I will send you this file immediately after the class, right? No, please, please don't shy away from asking questions. It's just that, you know, believe me, you can ask me any question offline, right? Pertaining to trading, mind. No, I mean, no, seriously, right? It's just that sometimes if the question is out of context, it just disturbs the flow. So, I mean, the more questions, the merrier. If the question is out of context, I'll be more than happy to take it offline, right? So please ask as many questions. I really don't mind. And we can schedule calls also, right? You can download these slides from LMS, yes. Yes, you can do for asks as well, based on best ask. Absolutely. Absolutely. Don't worry about it. Okay. You can contact me through support, right? Till you are associated with Quant Insti, you can always contact me through support, right? The order book removes all the trades. Yes, all whatever is traded. So once the liquidity is removed, they will remove those orders. Yes. Let me not disclose whether I've used iceberg or let me not disclose anything. But I know a lot of people who use iceberg and pegged orders. That much I'll definitely say. Excel sheets would be uploaded on the LMS. Yes, so order books only keep those in the pipeline which are not executed, right? No, Excel, I will have a VWAP strategy on Excel in my trading systems class, right? So don't worry about it, right? So I will cover VLOOKUPs and offsets and whatnot. What is the time frame in which an exchange gets a tick? It can be nanoseconds, microseconds, right? Depending upon how is the order flow, right? All right. So you know what? It's high time. I think I will take one more question, and then whatever questions are left, please email me. I'll take them offline. Course test, check out LMS for tests and whatnot. You will send. I said I will send you a script. Just remind me. Just send an email and I will send you the macro to download from Yahoo Finance, right? You have to remind me these things, right? So just email me and I will send it to you, right? If there's an issue, you can just Google post only. They'll have a lot of good examples. If you're still unclear, send me an email. I will give you further examples for these, right? All right. Thank you so much, guys. It was great, taking this lecture with you guys. I really I'm enjoying each and every moment discussing all the queries and different order types and order books with you. Hopefully you had this was an informative session. I will, don't worry about things that have not been covered. I know what is to be covered and when. So, I will, in due lectures, I will cover all these things. Thank you so much for attending this class. I really wish you have a great week ahead. If there are any questions, as I said, please email me or you can schedule a call. I'll be more than happy to help you out there, right? All right. I mean, this is flurry of questions. So, whatever question is left, just email me, right? I'll be more than happy to cover them offline. All right. Thank you so much, guys. It was a pleasure taking this lecture. All right.